Cautious navigating this landscape. We want to bring in Philip Streible. He's Blue Line Futures Chief Market Strategist joining us now. Philip, it's great to see you again. So here we are with gold prices right around 2,100. Now, it is important to point out just in terms of when you adjust it for inflation, gold actually set a higher highs when you look back to the 1980s and some of the prices that we have seen in the past. But take into account where we are today, gold just above 2,100. Philip, do you think there's more room to the upside?
Oh, I think so. We've got a perfect storm brewing in the gold market with opportunities in silver. I mean, we're $150 above the February lows. You've got U.S. and European inflation data that's been weakening, and the prospects of the Fed, the ECB, and the Bank of England all to have interest rate cuts are rising. So in May, we're expecting about a 23% chance that the Fed will cut rates. You go out to June, it's about a 65% chance. But I really think kind of the details of this gold rally, because if you look when we took off, it was basically Thursday near the close is when gold futures really started to get their legs. And I think that there's another regional bank crisis that's kind of lingering in the background. Since that close on Thursday, New York Bank Corp has been down 38%. And I think that the reality is that you're seeing this short covering because of the fact that if you do have some kind of bank failures, some kind of regional bank risk, you're going to see it pull forward those interest rate cut expectations by the Fed, and they'll end up making those cuts a little bit sooner.
And in that case, we'd also be apt to keep tabs on any incoming economic data. Is there one particular print that has a more outsized impact on gold as it translates to the rate cut probability?
Well, of course, it's going to be the jobs number on Friday. If we see any number that's below 200,000, I think that will expedite the prospects of the interest rate cut. The last number was about 353,000, so it blew the socks off. That's when we saw prices come down. But I believe that some of these seasonal factors have come out of the market here as far as the job market. I think that there's significant underinvestment also in the gold market right now. If you look at the ETFs, it's been just nothing but a series of outflows on that market. Even with prices going up, we saw about $155 million in ETF outflows out of the GLD market. Perhaps those were people that bought that recent record high that occurred on a Sunday night into a Monday, and they've been holding on to that. Now we're seeing that rotation out of gold and into Bitcoin, which is attracting about $1 billion a week in ETF inflows.
And that's what I was just about to ask you, Philip. How much of that gold outflows in the ETFs are we seeing now flow into digital gold?
Yeah, I mean, and the reality is that I think that there's a place for both physical assets and also digital assets in people's portfolios. I think that it'll help them against, a macroeconomic backdrop here that is starting to waffle a bit. And then also it will help with the purchasing power going forward. So I think it's a play for both portfolios. If you look at when the GLD started about 2004, over the course of the next 7 years, those ETF inflows that went into that asset class took gold from $400 an ounce on up to a record high of about $18.50 an ounce. That's why we believe that with the way the ETF is setting up for Bitcoin, we could easily see $100,000 Bitcoin at the end of the year, and perhaps 2 and 3 years out, $250,000.
Phil, what do you think the price of gold looks like a year out?
Well, I think we could be easily back up at 2,500. If you go since 1990, within the first 30 days of the first interest rate cut, gold futures on average have had a rally of about 6%. So if you go 6% from here, that's going to be about another $150 higher. So I think 2,500 is a realistic target. The key catalyst on the gold market is the timing, the pace, and the depth of the interest rate cuts. The Fed has really two options. They go slower and sooner, start in March, or they got to go faster and later, starting in June. And if they do that, that's where things can really get a bit haywire on the gold market. And I think that, again, with the gold silver ratio sitting around 89-90, that you could see a really aggressive move on silver higher.
Since you mentioned silver, what's going on with the level of resistance, this thick area, as you define it, in resistance that's taking place within silver?
Well, silver, the range on the upside where we started to pump the brakes has really been 24 to 26. Remember, China is one of the largest consumers of not only silver, but also copper. And with solar stocks under significant pressure, they're one of the most heavily shorted sectors in the market. I think that there are some headwinds for the silver market, but like any balloon being held underneath water, eventually when it comes to the surface, it explodes significantly higher. So we do believe that we've captured some key levels of resistance. Just in the last 2 days, silver's gone through the 50-day moving average, 23.32, also above the 200-day moving average at 24.02. I would say your line in the sand is going to be that 50-day. If we go back below it, prices could be just rolling over, and this was nothing more than a head fake. On the gold market, your critical level supports 2100. Below that's going to be the 50-day moving average at 2055.
Phil, we got to go. Is there one metal that you're tracking that perhaps is annexed to this boom that we've seen in semiconductor demand?
Copper market could easily take off to the upside. We could see $4, even $4.50 copper if China starts doing some stimulus measures.
Philip Streible, who is the Blue Line Futures Chief Market Strategist. Thanks so much for taking the time here.